Okay. Okay, great. Hello, everyone, and welcome to another session in our Markets Masterclass series. So I'm Sapna Patel, part of the large corporate FX sales team at Lloyds. And joining me today, we have Colin McKee, who's the head of our financial risk advisory team, and Chris Munson, who sits on our corporate sales rates desk. And today we're going to be using the next 30 minutes or so to cover the topic of risk management within the M&A space. So a few bits of very important admin before we kick off. So to keep the call nice and clear, we've disabled all cameras and microphones. If you do have any questions during the call, then please feel free to put those in the Q&A chat function, and we'll do our best to get through those at the end. And additionally, if you've got team members who can't join today, then a recording of the call will be available on our website, and we will share the link once this is live. Also, lastly, we welcome all feedback. So if you've got any thoughts or suggestions for other topics or things that you would like to see, then please do let us know. So let's kick off. So Colin, Chris, do you both want to briefly introduce yourselves before we get into the nitty-gritty of this?
Yeah, thanks.
Sure. Thanks, Sapna. Shall I start, Chris? So Colin McKee, I head up a team in Lloyds called Financial Risk Advisory. We work very closely with the FX and rates derivatives teams, also the financing teams. And really the purpose of the team is to help companies to understand some of the financial risks that they're facing, whether that's business as usual or through something like an M&A transaction, try and analyse those risks and sort of look at ways of maybe mitigating or managing them. Chris.
Thanks, Colin. Yeah, good morning or good afternoon now, everyone. So I'm Chris Munson. I'm a director in our corporate finance and risk management team within our capital markets business, and our primary focus is really to support clients and structure hedge solutions for our client base, and a lot of that is around corporate M&A. So I'm really pleased to be talking on the topic today.
Colin, shall I hand over to you?
Yeah, perfect. Thanks again, Sapna. So I suppose first of all, why financial risk management and M&A as a topic? But maybe firstly, after I think what we'd all admit was a pretty quiet year in the M&A market last year, things are picking up. That's borne out both by market sort of data, market evidence, if you like. Also anecdotally, I'd say, we here at Lloyds have been involved in quite a number of transactions late last year and certainly carrying on this year, which are M&A related. So that is good to see and positive. And then maybe secondly, and I am probably biased in this given what I do, I think this is a really interesting topic for risk management. Why is it interesting? Well, it's complex. There's lots of moving parts. Companies are normally issuing new debt. They might be issuing equity. Bigger transactions, they might be divesting of bits of their business for competition laws, etc. There's generally uncertainties over the deal timeline, the deal completion that have to be dealt with. People in companies are juggling with lots of different balls. There's different work streams. They're trying to do sort of BAU at the same time. So yeah, lots of moving parts. And probably one of the key takeaways of this is that while all of that's going on, it's really important to focus on the risk management as well and not sort of leave that as an afterthought. So it's important to build it in early into the deal financing discussions, into that work stream, and to try and sort of fully integrate it into the process. And that's not just hedging with derivatives; it's also to do with the currency mix of the debt, if you can get that debt directly, for example, and transaction structuring. So moving on, then, how do we deal with it? How do we try and make sense of some of these sort of moving parts? On the next page, we've given a very brief, as you can see, overview of how we think about risk management in M&A. And this is really sort of a four-step framework. Obviously, each transaction is different. It has its unique sort of facets, but this is a sort of framework that can be applied to most transactions that we deal with. So first of all, maybe slightly counterintuitively, well, where do we start? Well, often we start with where we want to get to. So in any M&A transaction, and generally we're talking about sort of cross-border acquisitions here, just to be clear. Often the group is sort of changing in scope and size, in currency mix. It might be levering up. So with that change, one of the things we suggest that companies start with is looking at where they want to get to from a sort of optimal currency mix point of view. So, optimal debt mix point of view, both currency and fixed floating. And we'll walk through these 4 steps via a case study over the next few slides. So having looked at that, having looked at the sort of new cash flow mix of the group, the sort of strategic focus, the metrics, etc., and worked out initially what do you think a sort of sensible debt profile looks like. Step 2 is then, well, how do you get there? And it might seem like an obvious question. Well, you maybe borrow in those currencies and fixed floating mixes, but that's not always the case. Often companies are constrained in the currencies they can borrow in. If they're borrowing bank debt, that tends to be floating, obviously. They might want fixed rate debt to protect metrics, etc. So step 2 is really looking at how you get from the initial debt profile to where you want to be, and the optimal profile for the company, for the enlarged group. And having done that, step 3 is then looking at near-term or initial FX transaction risks that fall out of the transaction. And it's really important, I suppose, to note that that can only really be done once you know what the financing structure is, so via steps 1 and 2, because that then feeds into what those FX risks are and sort of determines the currency pairs in play. So what do we mean by FX risks? Well, often in these acquisition scenarios, the acquirer is paying in a currency other than its home currency, if you like. So a sterling company paying in dollars or euros, for example, and FX risks can drive transaction economics and indeed sort of viability of the financing package. And then finally, we said analyze interest rate risk and determine the hedging strategy. This is really to do with maybe larger transactions where initial bridge financing is being taken out with maybe longer term funding via the capital markets, private placements, bond markets, etc. So really thinking about the pre-hedging strategy for those fixed term instruments. So to try and bring that to life a bit, we have put together a case study, hypothetical, but based on transactions on which we've worked over the years. This is an illustration, I should say, but hopefully it works well for these purposes. We have tried to make it complex enough to bring out the parts, but not overly complex that people won't be able to follow it. So what do we have? We have a UK group acquiring a European business. So UK group is Company A, headquartered in the UK. It has the majority of its income being generated in the UK, a bit of Eurozone income, a bit of dollar income. It is acquiring Company B, quite a sizable acquisition. So I've summarised the financial information in the table at the bottom of this page. So Company A has EBITDA of 100 million sterling equivalent, Company B 40 million equivalent, so a chunky acquisition. The purchase price for the acquisition, we've said, is 230 million sterling equivalent. So that is the bottom of the middle column where you have sort of target Company B, the equity value of 230 million. What else is relevant in this table? Well, Company B also has some existing debt. It has 70 million equivalent of debt, and that debt happens to be in euros. It's a European-based company, so it's local currency debt for it. So in order to complete the transaction, the acquirer, Company A, has to pay the purchase price, the equity value, and it also has to refinance that debt. So in total, it needs to pay 300 million sterling equivalent in order to complete the acquisition. So that's for the equity value and the refinancing of the new debt. So as I said, the information is summarised in the table at the bottom. The main things probably to call out are the EBITDA levels that I've talked about already. We have the pro forma group on the right. So what does the combined group look like? So as I've said, EBITDA has significantly increased. Net debt has increased from, on the left-hand side, 150 to 450 on the right-hand side. So this is a wholly debt-funded acquisition. All of that sort of 300 acquisition price, as I've said, is funded via new debt. As a result, leverage has increased notably, so from 1.5 times to 3.2 times. That in itself has risk management consequences. And just to make it interesting, we've said that the purchase price is going to be paid in dollars, just to bring in a new currency. So Company B is owned by a dollar multinational, and it wants its proceeds in dollars, maybe fairly. So how do we apply the framework to this case study? On the next page, so the first step in that framework is thinking about the post-acquisition debt composition. And one way to do that is to look at the currency split of EBITDA on the top and then of net debt along the bottom. There's lots of ways to think about this, but let's walk through this example maybe and see where we get to. So company A, as I've said, has mainly sterling earnings, so roughly 80% of its earnings in sterling, a bit in euro, the rest in dollars and other. Company B, predominantly euro EBITDA, again a bit in dollars, such that on the right hand side the pro forma EBITDA, the top right sort of chart, the donut if you like, the combined group has roughly 50% of its EBITDA in sterling, roughly 40% in euros, and 10% in dollars and other. So how does that match with the debt profile on the bottom? So company A, all of its debt is in sterling. As I think I said previously, it's 150 million of debt, all in sterling. It's all bank debt. It's all floating. Down in the bottom middle, the 300 million is the incremental debt that will be taken on in order to complete the transaction. So some of that is existing company B debt that's refinanced. The rest of it is to pay for the equity, as I've said. So the question is really, well, what sort of currency mix, fixed floating mix, should the combined debt profile be in? And one of the common pitfalls maybe is that I've said earlier, well, the company is paying for the purchase price in dollars, and it's also refining some euro debt. So let's look what happens if we put the new debt in those currencies. How does that bottom right sort of currency mix change? Well, you have, again, the same 150 million of sterling debt. You have 70 million sterling equivalent of euros, and you have a large chunk of dollar debt. Why might that not be the optimal strategy? Well, if you compare it to the EBITDA mix, it looks very, very out of kilter. So that was really just to try and make the point that the currency in which you're paying often is not the right currency in which to think about putting new debt. So maybe something that's a little bit better aligned to the currency mix of EBITDA is shown on this page, where we have the bulk of the new debt actually being put in euros rather than dollars or rather than sterling. And that, as you can hopefully see visually from the charts, gives a better alignment with the EBITDA mix, which is one of the ways in which you can think about optimal currency mix of debt. There's plenty of others which we'll touch on later. I should say as well that this is just currency mix that we're showing in these slides. In reality, for any sort of sizable transaction, you would do a much more in-depth analysis. You would also think about interest rate risk. So, for example, I said previously that the leverage has gone up significantly from, I think, 1.5 times to over 3 times. So I think most companies would not want all of that debt to be in floating, for example. So think about sort of hedging the interest rate risks in a slightly more complicated version of this. If that is where you want to end up, then the second sort of column or the second step in that risk management framework is decide how you get there. And this isn't always an obvious question, or maybe there isn't always an obvious answer to it. There's another way of saying that. On this page, we've shown the acquisition debt on the left-hand side, and then just going back to that previous slide, maybe the desired profile from a currency mix point of view on the right-hand side. And again, for simplicity, we've just looked at the currency mix. We haven't touched on interest rate risk on this page. So on the right-hand side, that's the same as was shown on that previous chart, where there's roughly a sort of 45%, 10% split of debt between sterling, euros, and dollars. It seems quite well aligned to EBITDA. On the left-hand side, how does the company achieve that? Well, this is surprisingly common, and maybe in particular on smaller M&A transactions. The company in question here, Company A, only has access to sterling funding via the bank market. So it has its existing debt of 150 million and a new acquisition facility of 300 million in this case, which can be drawn in sterling. So how do you close the gap between the left-hand side and the right-hand side? Well, one way of doing it is via cross-currency swaps, either into fixed or floating. So we've tried to illustrate that a significant portion of that sterling debt would be swapped into euros. So the company will be paying euros in the end, and again a portion of it into dollars as one way of getting to the desired debt profile. I think I'll pause there, and Chris, I think I'm over to you now.
Thanks, Colin. Yeah, and as Colin's outlined, the currency of funding is a really important factor when making cross-border acquisitions. And again, the key point to highlight here is what Colin's already touched on, is the currency of debt that you're trying to target and get to in terms of the desired pro forma structure is not necessarily what's available in the market. And Again, that could be due to the size of the facility, liquidity, investor appetite in a particular currency, or it might be cheaper to raise funding in a currency that's not actually the currency you want to end up with. So again, in all of those scenarios, companies will typically swap debt from one currency to another, and that eliminates any exposure in that base currency, and that's on all future interest payments, principal repayments. It's a way of synthetically getting the desired currency for the debt that you want to end up in. If we just move on to the next slide, Colin. So we've talked about that end position and desired currency split, but what determines that currency split? How do you derive and get that desired position, end position? There's no particular way that is right or wrong. I mean, different companies will approach this in different ways, and that will come down to leverage, existing overseas operations. We've just highlighted a few here that are typical factors when determining that currency split, some of which are tactical decisions, some of which are a little bit more strategic. But the four we've highlighted here is outlined on the page, and cash flow matching is a big one. It's a fairly obvious one. So typically cash flows generated from foreign operations want to be naturally used to service debt in the same currency. So again, you'll see cash flow matching from overseas operations or an acquiring business to then structure at least a proportion of debt that fits with that ratio of overseas revenues. The other one is, and again, this is probably typical in more leveraged transactions where covenant ratios and kind of credit protection is more important. So again, you might want to be targeting gearing or net debt to EBITDA ratios. Again, if you've got all sterling debt, you're making euro US acquisitions, you've got a much bigger mix of EBITDA and other currencies. The last thing you want is obviously the earnings to be translated back into sterling at a lower rate from a big FX move, and suddenly you're up against a leverage covenant that you shouldn't be. Again, if you're structuring more of your debt split on EBITDA, that starts to ease some of the pressures around covenants on FX risk. Net assets is another big one as well. So net investment hedging. Some companies are very focused on ensuring that net overseas assets are as low as possible. So again, you're looking to maximize the amount of liabilities you put in against overseas assets effectively. So that it's just a way of reducing your net asset position by matching your overseas liabilities with your overseas net asset position. On that one, you have to be slightly careful. What you don't want is to have going over that amount and effectively having more net liabilities than assets. But again, it's something you can manage on an annual basis. The last one is a very obvious one, which is the cost of funding. And the interesting point we've highlighted on the charts on the right here is for the last decade or so, and certainly through COVID years, there hasn't been a great degree of difference in policy rates for a lot of the developed nations. So therefore, the relative cost between sterling and euros, for example, wasn't a huge difference. Now, clearly, as we've been through the last 2 years, developed nations have struggled with incredibly high inflation rates. Central banks have taken slightly different views on how to tackle that, but most of them have been aggressively hiking their own policy rates. There is now this divergence between relative interest rates. So you can see on the chart on the right, we've just mapped out where 5-year fixed euro swap rates are against sterling swap rates. And you can see they've both risen, but obviously that gap and divergence between the two is rising. And that's the lower chart, which shows there's now about 130 basis point difference with euro rates now being lower when hedging out to 5 years versus hedging in sterling. So again, that starts to become a factor of relative cost of overfunding in another currency, obviously assuming that you don't start to breach covenant issues, net asset position. If we just move to the next slide, Colin. And then the kind of final point I want to touch on is the age-old decision between fixed and floating rates, which again has had a degree of different opinions depending on where we have been in an interest rate cycle. Again, if we look at the last decade or so, the relative difference between floating rates and fixed rates have been low because both elements have been low. There's now quite a stark difference between fixed and floating rates, and even over the last few months, and we've just shown here over the last 2 years, there's clearly been a huge change in floating rates, which has actually created a different kind of cost to carry in many currencies. So that cost to carry refers to is the difference between floating overnight rates and medium-term fixed swap rates. That's now turned negative. So in both euros and sterling, you can see here on the chart, the dark green lines are the 5-year swap rates, and the blue lines are where the overnight or central bank rates are. So 2 years ago, there was a cost to hedge of about 100 basis points in both currencies. Medium-term swap rates were about 100 basis points higher than the floating rates. As we've seen the programme of cycles from both the ECB and from the Bank of England, we've now got the opposite scenario. We've now got effectively floating rates, which are much higher than the medium-term fixed rate. So now we've got a negative cost to carry of about 120 basis points in both currencies. And again, Colin touched on this earlier, but there's obviously also a dynamic of what type of currency you obviously choose, but equally what type of funding you opt for. So bank market being floating rates, you might look to hedge to fixed. Equally, if you start to look at the bond market or the private placement market, typically that's majority comes as fixed rate debt. So again, some issuers are issuing fixed rate funding and then swapping it to floating with the view that we see central bank cuts coming over the next year or so. There's a big piece around pre-hedging as well. So again, when you're looking for funding, as you start to approach the point at which the debt needs to be in place, there are ways to de-risk the company from yields increasing and the cost of your debt increasing. We'll probably save that for another time. Right, I am conscious of time, so I'll pass over to Sapna to touch on some of the FX elements.
I think back to me as a quick interlude before Sapna. So just going back to our framework, step 3 then, so having looked at the optimal currency and fixed floating mix of financing, having looked at how we get there, maybe via cross-currency swaps, etc., we can now look at FX transaction risk. And I will keep this brief. Again, we've tried to summarize the case study fact pattern on this page. And this is a fairly classic sort of sources versus uses approach that you see in M&A transactions. So on the schematic on the right-hand side, we have sources. So what are the sources of funding for this transaction? And I've shown the existing debt at the bottom for completeness, but we can essentially ignore it. The new debt is 300 million sterling equivalent, sorry, direct sterling, actually, sterling bank debt. On the right-hand side, what is that going to be used for? Well, 2 things. So at the top, it's going to be used to repay the existing debt in the target in company B. So that is 70 million equivalent, so roughly 82 million euros, let's say, denominated in euros. And then I said towards the start of the call that the purchase price for the transaction is in dollars. So the equity of company B is being purchased for a dollar purchase price, so roughly $300 million. So looking at the left-hand side versus right-hand side, it's fairly obvious that the colors, the currencies don't match. So what is the FX risk that company A is running? Well, it's sterling versus a large chunk of dollars for roughly 230 million, and then 70 million equivalent euros. So that's a commonly used way to illustrate sort of sources and uses of funding and sort of tease out FX risk, which can only really be done once the funding strategy has been determined. So Sapna, I think over to you in terms of how one can think about hedging that.
Yeah, thanks, Colin. So from an FX perspective, there are a few ways in which we see corporates address this FX exposure within the M&A space. So firstly, the first option you see there is to remain unhedged. So there can be a lot of uncertainty around M&A deals, and often with many moving parts, moving timelines, it may be a consideration actually not to hedge your exposure at all, or perhaps hedge a portion of it. And this, I guess, moves us nicely on to the most common way in which we see FX being hedged in these situations. And that's via FX forwards. So more often than not, most M&A deals will have a signing date and then potentially a separate payment date. So really allowing some time before the actual payment needs to be made once the deal has been agreed. So in our example, this could then mean that an FX forward hedge could be entered into could be entered into on the date which the deal is actually signed, meaning that there's certainty around quantum, dates, and actual requirement of funds that are needed. So moving on to another option that allows you to do this is an FX option, which is, to be honest, generally less popular in these scenarios. Now, the reason for this being slightly less popular is due to the fact that there's typically a premium associated with entering into an FX option, whereby you have the option but not the obligation to buy the currency that you require at a specified rate. So this choice would be useful, for example, if you wanted to hedge before the signing date, as you know, say hypothetically there was an 80% chance, an 80% certainty around the transaction going ahead. It could be deemed that 80% means more than likely, you know, it is more than likely to go ahead, but there's not 100% certainty around the transaction. So it could be that entering into an FX option and paying an insurance-like premium will ensure that you are hedged sooner rather than later. However, if the deal was to fall through and not go ahead, the only thing that's really lost is the premium paid. And then lastly, deal contingent forwards. Now, this is not now this option isn't one that's necessarily readily available, so to speak. So different banks will take different approaches when it comes to deal contingent forwards. So it is definitely a more timely, lengthy, and documentation heavy process. In effect, what you're doing is you're entering into an FX forward, which is contingent on the deal going through. So the price of the FX forward will reflect the contingent nature of that scenario. And it's also a scenario where banks will typically need to seek approval on entering into this type of transaction internally. And again, this will depend on the notional amount, tenor, perceived certainty, and many other factors that will be involved. So not an option that we see being used very much, but definitely one to bear in mind if of interest, and definitely one that you can speak to Lloyds about. So those are the main options and scenarios from an FX perspective. And Colin, I'll hand back over to you just to wrap up.
Great, thanks very much, Sapna. So that was a bit of a whistle stop of M&A risk management and how we think about it, using obviously an illustration. There's many variations on a theme, but some of the key takeaways for me would be: don't overlook risk management. You know, there's often lots of focus on the financing, on due diligence, on, you know, running towards deal completion and making sure all the milestones are hit. Build risk management into that process, in particular dovetail it with the financing for the deal, because the two things are very evidently interlinked. Understand the size of the risks that they're running. You know, Sapna talked about perhaps leaving the FX risk unhedged if it's not sizable. That is definitely one approach. You know, do you need to hedge it? Have you analysed the impact of it if your local currency depreciates, for example, against the target currency? So, you know, be aware of the risks that you're running and what drives those risks. Again, coming back to the linkage between the financing for a deal and how that can impact the FX risks. And finally, I would say lean on your banks and advisors. There's a lot going on during M&A transactions. Use your banks, advisors to provide bandwidth, analysis, and to help you develop a strategy. So those are probably the key takeaways for me.
Great.
Sapna, I think we're back to you.
Yes, thank you. So I think we've managed to cram an awful lot in the last 30 minutes. So hopefully that's given everyone a good overview. We've evidently bombarded you with lots of information, so there aren't any questions in the chat. But given the time, I say we're finishing there bang on 12:30. So if you do have any questions, then please feel free to reach out to Colin, Chris, or myself. And we've got our teams and ourselves who we're more than happy to help. So please feel free to reach out. You can also sign up to the mailing list on our website to receive these monthly invitations straight to your inbox if they are of interest. But other than that, I'll leave it there and hopefully see you next time. Thanks, everyone.
Thanks.
Thank you.